Hi, hello everyone. Thank you for joining. I'm Rob Maxim, and we have a wonderful webinar here put together on mitigating valuation uncertainty. A few housekeeping items before we dig in. As you can see, these are positions that the discussion here is really from the panelists. They don't represent Kroll, and information presented here. It is believed to be reliable, but not guaranteed. So, please take it with a grain of salt, particularly as it relates to data, as some of this is a week or so old. So, because we had needed some time to put things together. Very quickly, just an overview of Kroll. Kroll has a number of different advisory scope practices. We have valuation, cyber risk, digital technology solutions, compliance and regulation, corporate finance and restructuring, investigations and disputes, environmental, social, and governance, as well as business services. If we can assist with any of that, please give us a call. As we go through this, if you have any questions, we do have a Q&A box. Please type your questions in, and we'll attempt to get to them as we go through this. Quick overview. We'll do some introductions, and then we'll jump right into it, running through what's going on related to valuations and how to mitigate uncertainty. Some brief introductions. I'm Rob Maxim. I'm a managing director in the Financial Instruments and Technology Group. I focus on valuing a broad range of financial instruments. Valuation purposes range from financial reporting to disputes, as well as various activities related to restructuring and different investment banking activities. In doing so, Kroll focuses on really being a valuation expert, and we bring a ton of expertise to this area. If you're unfamiliar with us, here's a slide showing some of the different ways in which we really contribute to the valuation community. We have folks serving on the AICPA. We have folks assisting in writing the IPEV guidelines for evaluation. We have a number of people actively involved in the IVSC board, and really helping to shape sound valuation practices. With that, I'll hand it over to John.
Thanks, Rob. My name is John Ward. I'm one of the co-founders of Allume Partners, LLC. Allume is an independent operational due diligence provider. All of the founders are well-seasoned experts in the area of operational due diligence. And I'm joined today by one of my co-founders, Paul Roth. Paul, do you want to introduce yourself?
Hello, Paul. I have about 25 plus years of operational due diligence at various entities, Texas Permanent School Fund, and Delaware Public Retirement recently.
Paul, did you want to say a little bit about Allume?
Allume, it's John. I'll just quickly jump in. Allume was a recently founded firm. It was founded earlier this year, and our basic services are obviously operational due diligence for institutional allocators, and we also work with fund managers of all types and all strategies, helping them become more institutional in their processes and policies and procedural controls. And lastly, we also have a material focus on doing due diligence on vendors, counterparties, and service providers. The SEC has given guidance around that managers should be doing more due diligence. It is obviously not yet a rule, but we are getting a lot of inquiries around that area, and we are happy to help managers who are taking on the responsibility of undertaking vendor and counterparty due diligence. Andy?
Thanks, John. My name is Andrew Murray. I'm a managing director at Victory Park Capital Advisors, a global alternative investment firm specializing in private credit. I've been with the firm for coming on 11 years now. I lead our valuation process, along with treasury, investment allocation, performance analytics, along with a bunch of other operations tasks within the firm. And then I'll pass it back over to Robert and kind of start to hit on some of the topics we're going to cover today.
Yeah, and thank you. I appreciate everyone joining me on this webinar. As you can tell, we've got operational due diligence professionals who have come from a broad range of backgrounds as well as investment managers. So thank you for joining me here. So focusing on kind of what's driving a lot of the questions surrounding valuation uncertainty. There's a lot of different sources of valuation uncertainty. These can range from uncertainty in liquid markets, and I think people often forget that even in stock markets, you can have two trades at the same time at different prices. We have processes in place, we have procedures in place to come up with, in more liquid market, estimates of where trades are occurring. But as you get into less and less liquid markets, the uncertainty grows. There's less information about trades, but that need for policies and procedures to come up with valuations really doesn't change. I think there's still a strong need for that. And in fact, they become more important in my mind because the information really is potentially less available. Kroll has a number of solutions that hit on that, but and we'll talk about a few of those. But I think that almost by nature, these sorts of investments are inherently surrounded by less information. And so that process and that procedure becomes more important for estimating values. I guess another item that really contributes to valuation uncertainty is the degree of uncertainty that we're facing in the current economic environment. There's a lot of shifts in our economy that have occurred. People aren't going into the office as much as they were prior to COVID. Their interest rates interest rates are high. Inflation continues, and all of that leads to potential binary outcomes from a valuation perspective, and really puts an emphasis on having a robust policy and procedure to estimate those valuations. Another thing that I've noticed lately is that there is a lot of information asymmetry. So, for instance, if you are the mezzanine lender on a commercial real estate building, you may have one set of information, and the senior lender might have another, and the sponsor, the owner of the building, may have another set of information. Everyone's going to approach the valuation with the information they have, and there are different times where it might be important to incorporate that information. But gathering all the information that you can and incorporating that into your valuation is an important process. But that asymmetry is inherent to many of the types of credit investments that we see through time. And of course, there is a piece that I think is really what folks are concerned about, and that's poor oversight and governance of the valuation process. Andrew, do you have any? I know you as you're managing valuations at Victory Park, you're probably encountering a number of these. Any insights here?
Yeah, I think given our kind of space and truly private credit, doing private deals, we're the sole lender in these deals. I think a lot of these kind of hit different areas. I think one of the main things we have is market data limitations, and like price discovery, I think is always a struggle for us. I think we do a great job of understanding our collateral, how to value our collateral, but understanding what a third party or fair market participant would pay for that, given our pricing, is kind of always been one of the bigger struggles. And given a lot of the limitations and just not pure comps, not a lot of great indices that have a lot of specificity into what we're trying to mark to, always is kind of our biggest kind of driver of uncertainty in how we are marking our book on a regular basis. I think we get pushed back the most when we go through our process. But like I think you hit on, the private market in credit has continued to grow a lot. I think that's also led to an influx of much more educated and sophisticated investors. So on our front, we've always been driving to have best-in-class oversight and governance in our valuation process. And I think we see it every day when we're meeting with new potential LPs, when they're doing their due diligence on our side of the book, that they want to understand that we have a fulsome policy in place, that we follow it on a regular basis, that we have the procedures, that we have, using the correct third-party expertise to validate our marks. And I think we continue to shift more and more to the institutional side in how the public markets view valuation, but there still is a lot of the inefficiencies on the private side that we still kind of work through on a regular basis. But definitely a much more educated investor class coming in and demanding more and more oversight on the overall valuation process, I think is one of my key takeaways, the current environment.
And so moving to just kind of setting the stage, why do we see more interest in valuation and valuation of private credit in particular? I managed to find a couple of slides from a study the Federal Reserve put together showing the growth in private debt and direct lending over the last few years. And as you can see, that's growing to north of $2 trillion. And that's a pretty dramatic growth over the last few years. Andrew, is that consistent with what you're seeing?
Yeah, we currently see that kind of market AUM right at $2 billion. There's other market participants that view the addressable market is actually closer to 40 trillion. And that's coming from Apollo. So we think there's a lot of white space in this market. It's being driven by a lot of market volatility, obviously the rising rate environment, persistent inflation, and also bank pullbacks have kind of really opened up a lot of this space. We do see some other trends. I think insurance money's been coming into the space a lot more over the last few years. They're, in a sense, kind of replacing some of the smaller regional bank players that were in this space. So there is kind of this dynamic shift between who is the underlying kind of backer to a lot of this private credit, where it used to be a lot of small regional bank players, where now it's starting to become a lot more larger insurance through different fund and asset managers kind of being the money behind it.
John and Paul, are you seeing similar shifts on the ODD side?
It's John. I think I'm seeing clearly a pickup of interest from institutional allocators, institutional investors. For much of, let's say, the last decade, there's been a slow transition from folks that are largely focused on hedge type investments, hedge funds. We saw an explosive growth in private equity and venture capital over much of the last 10 years, as that became more of a focus for investors. And I would think private credit, direct lending has been a little bit more recent. So I think that's maybe close to the last 3 to 5 years that we've seen institutional interest in investing in funds and other instruments, co-investments that available from managers in private credit. Again, I'm not in any way saying these funds didn't pre-exist this time, of course. I'm just saying that institutional allocators, as they are looking to find returns, have been going through the different strategies. Some folks dabbled with crypto and things like that, and may or may not have had a very positive experience. But I would say that private credit and direct lending has been a relatively more recent investment strategy undertaken by global institutional allocators.
And focusing on the economic environment, Kroll has a data set that we've in working with many of the large private equity, hedge funds, levered loan funds. We have a database of kind of where different types of loans have been originated. These indexes come from that. And if that's something you're interested in, please reach out. But I thought it was interesting looking at these levels. You can see that COVID, there was a little bit of a bump in 2020. And as you move to 2023 and 2024, you can see that the rates went up. Now, much of the driver there is the increase in interest rates, but they're up at levels that we really haven't seen over the last 8 years or so. Andrew, how does that relate to what you're seeing on the valuation side?
Yeah, obviously, a lot of our investments are floating rate. So in some cases, that could be putting pressure on the companies to ensure that they have the cash flow to service these loans at a much higher yield. I think it also kind of plays back to like what are target returns we're looking to hit. I think there's been a shift over since 2020 to 2024 where there's actually been a lot more healthier credit coming into the private credit space because of the bank pullback. So yes, the overall pricing has gone up, but you're getting kind of a better look at a lot of healthier deals that used to be banked by banks that now are kind of shifting into the private market. But yeah, I think we have to be very conscious of it. There's only certain levels that healthy companies can kind of afford on a credit load. So we're constantly looking at that, and it's not a straight line where we're saying, hey, our book priced 12% 3 years ago, it now needs to automatically price 5% higher. It's just in some cases, companies can't handle that level of debt servicing. So it has been interesting in terms of just the overall pricing of the market, everything being higher. I think it's made alpha a little harder to seek given just where risk-free rate is. And because of that dynamic where you just can't always find a venture younger company that can really afford a high teens interest rate, where before you were creating quite a bit of alpha in the low teens, but now with healthier credits pricing up to there, it's definitely created a little more interesting kind of deal flow dynamic. And then obviously on the valuation side, it has created more pressure on just how are you viewing it? Are we doing the diligence on the underlying collateral to ensure that the cash flows are going to be there to cover it? Are we looking at mark-to-markets? Like, how is the overall market continue to price versus if we did a deal 3 years ago for now? Luckily, on the valuation front, a lot of our stuff does have floating rates. So that does ease a little bit of the kind of mark-to-market marks you'd be kind of looking at when you're running through a yield analysis. But yeah, it's definitely something we're currently conscious of. And obviously, people think in the near term, there could be pullback on overall rates. But in the current environment, we're kind of still uncertain if that'll happen 6 months, a year. So it's been a lot of uncertainty.
And along those lines with the uncertainty, John, I think when we were discussing earlier, you'd mentioned that from an ODD perspective, as you're reviewing with clients how different prices have moved. Obviously, there's been a big increase in the yield to maturities for investments in the current environment relative to where they were in kind of the 2021, 2022 period. What are you seeing, and what are issues that you're, from a valuation perspective, that you're really honing in on from the ODD side?
Sure, I'll get started with some of my thoughts, and I'll let Paul jump in as well. Some of the things that we see that tend to concern us is managers who are holding investments at cost for a materially long time. Obviously, with rising interest rates, one would expect through much of late 22 and through much of 23 that the rise in interest rates might have had an impact on valuation of certain investments. And we saw managers who are sometimes willing to let positions in their portfolios be valued at cost for a year or more. Typically, we would expect, obviously, costs soon after purchase, but at some point, you would expect to see independent valuation. So it's usually a trigger if I'm seeing a manager and looking through their audited financial statements, and we're seeing the positions that were entered in materially many months or perhaps over a year ago are still being carried at cost in this environment. Cost may be the right price, but just using a flat, like we hold everything at cost for 18 months or 2 years, that seems to be a little favorable to the manager, wherein the underlying investments or portfolio companies, whatever the case may be, they may no longer be valued at cost. And the other area we're seeing is, to my opinion, too much manager marked positions, because obviously when we see positions where seemingly every credit or every position seems to move in lockstep with each other, that the whole portfolio goes up 3% or 5%, or goes down 3% or 5%, we would expect to see more idiosyncratic performance between different investments or different loans or different positions. And when we see sort of wholesale, we're going to move the whole portfolio up or the whole portfolio down, that is a little bit more concerning, unless it's a direct response to a rise or a decrease in interest rates. That type of wholesale, the whole portfolio went up, is more of a concern. Paul, anything that you've seen that you'd like to highlight?
Not really. What we look for on the ODD side is really a robust process that's adhered to in both good times and bad times. So that's what we like to see. Again, manager marks are problematic sometimes, but no, I think you covered it well, John.
The last thing, Rob, I would just quickly mention is somewhat of a concern, not directly tied to this, that there are still a lot of institutional allocators who downplay value under the assumption that it doesn't really matter what the value is today. I'm going to wait until the investment is realized in some future date. While that is obviously true, the value may go up and it may go down, and who knows what the exact value will be when the position is sold or matures. The reason that I think that fair value is a critical component is because most private fund managers are going to come on with later vintages, and they're going to point to the performance of their current vintages to say, hey, we're up 10, 12, 15, 18%. Please invest in our newest vintage. Well, if you can't trust the valuations on their existing vintages, how can you make an intelligent investment decision about deciding to enter in a current vintage coming to market? So while it's true that the values are going to be whatever they're going to be at the time of realization, I think it's important to see fair value so you can make an intelligent decision on future vintages.
And John, you bring up a good question. I think one of the impetus that we discussed when we were thinking of putting this webinar together was the fact that we were getting a lot of calls from investors, from managers, and from ODD folks asking how there's a lot of news coming out. How do we mitigate this? Highlighting that uncertainty that investors are seeing and managers. As an example, we just saw a CMBS for the first time where the AAA tranche, which was literally called the A tranche, took principal loss. And that hasn't happened since the great financial crisis. This was a case where a building, 1740 Broadway, which is in New York, was purchased in 2014 for $605 million. The senior loan on that was securitized in a CMBS, and just recently in April, it sold for $186 million. That $186 million, when you paid out the waterfall to the CMBS, that you had to pay out accrued interest to a number of the different tranches, accrued but unpaid interest, ultimately left the AAA note holders recovering 74% of their principal, and the other tranches, the tranches below that, effectively being wiped. They did get some of their accrued but unpaid interest, but they received no principal. Outcomes like that are across the commercial real estate industry are certainly highlighting to folks that there is some danger with investments and putting a lot of interest into how to settle these valuation questions and how to get comfortable that the valuations that you're receiving, the NAVs that you're getting from a fund, are accurate.
Rob, if I can just tack onto that, sorry for interrupting. I saw an article that came out today on LinkedIn. It's from a publication that I was not familiar with. It just came up in my feed. It's bisnow.com, bisnow.com. They had an article there restating that CBRE, a major commercial real estate entity, did an analysis of 57 different markets across the U.S. and found only 8% of commercial real estate is what they called thriving, meaning that they're keeping rents up. People are interested in getting into those buildings and that they are well leased and well rented, and that there is interest in getting into those businesses, into those buildings, So to me, that was interesting because obviously we all know that there's different buildings of different classes and different styles, and everybody says, it's a prime building. Well, it may be a prime building with a gorgeous lobby and beautiful facilities, but if it's not well rented and well leased, it's hard for me to say that is a prime piece of real estate. And if their numbers from CBRE are accurate, that only 8% of real estate, commercial real estate, is what they call thriving. It puts to wonder what the other 92% are experiencing. Some obviously are still doing fine with minor concessions, and others, as you see from 17 Broadway, have had a materially negative experience. So I just thought there was additional data point that came out this morning from CBRE.
Mm-hmm. No, and that really highlights an issue that I think a lot of folks are concerned about from particularly investors. From a manager perspective, Yeah, I've had a number of conversations with different managers that are really looking to shore up their valuation process because there is a heightened regulatory scrutiny coming around. We put a few examples here of cases where the SEC or the Department of Justice actually went through and levied fines, or in some cases, some people even went to jail related to subpar valuation practices. So there really is a need for managers to focus on this as well, as it is required for financial disclosure, among other things. So looking to ways to mitigate valuation uncertainty, what is everyone seeing in terms of successful ways to mitigate uncertainty, and what are kind of the rules that surround that?
So, Andy, I don't know if you want to speak to how your firm approaches it, but I think clearly there is an obligation. The SEC expects commingled investments where there are a variety of investors, so fund type investments, that there is a requirement to seek fair valuation. And fair value has some very specific language and obligations. And I think it's important that evaluation is just not a good to know. It's just not a nice to have. It is a requirement by the regulators to the extent that you are marketing your funds and that you have a commingled investment. I don't know, Andrew, do you want to talk a little bit about what your firm's approach is to fair valuation? And I'd be happy to talk to the operational due diligence side and what we look to see what managers are doing.
Yeah, definitely. So I hit on a few of the points earlier, but obviously having a robust policy in place is key, number one, in a policy that is constantly being monitored and updated. We agree the FSAB regulations drive our valuation. So we actually engage Kroll to provide positive assurance on all of our marks. Obviously, positive assurance isn't them independently marking it, but we think it gives us the ability to market that we have a robust process, that we are engaging experts in the valuation space on a quarterly basis to ensure that our approaches and techniques meet industry standards in a reasonable way. And I think back to John's part on the due diligence, I think over the last 7-8 years, really beefed that part up, where investors in the SEC just won't take you getting information from a management company as that's the golden word, and you can just take that for your valuation. So we do a ton of work on the risk side and back end, going in and diligencing these companies, ensuring that our collateral, a lot of the investments we do are ABL. So whether they're consumer loans, SME, some real estate, but mostly the lending side, we are going in, we're acquiring loan tapes, we're doing the real nitty gritty diligence to ensure that the data we're receiving from our portfolio companies is accurate and reliable when it comes to the valuation process. But yeah, I think it's a process that we constantly improve or constantly reviewing on a quarterly basis to make sure that there aren't any inefficiencies within it. We do obviously understand that this is a key point for the SEC if they ever to come in for an audit, that valuation is always one of their top 2 or 3 things I think they look at. They want to understand how you're doing it, how you're coming to fair market value. When there are issues with a portfolio company, how timely are you addressing that? So there is a lot of where they will come in, they'll want it backdate. They want to understand, how did this investment trend over 2 years? So back to some of the earlier points of managers wanting to hold assets at cost along with some investors until like there's an actual realization. Those days are just kind of behind us, where you have to be in front of marks, you have to be timely, you have to truly be taking approaches, and you can't just continue to play this way. We'll just see how it turns out. There's no real, it could go bad, it could go up. Like that's not the world we live in anymore. That we have to have models to support it. We have to have market comps to support where we're marking. So it has become a much more involved process. And I think not only on the SEC front, but investors demand that nowadays. I don't know an investor that would come in and be like, oh, you guys just keep it at cost and don't do any analysis. You're not doing anything. I would like to understand those investors that are invested in funds, but it's not what we see on a regular basis. So we're constantly pushed on the LP side. We're pushed from the SEC. I think we're also pushed in by Kroll as our partner to make sure that we're always going above and beyond and like keeping up with industry norms and just always making sure that we're not just keeping a mark because we want to keep it there, that there's defensible support around what we're doing.
And Andrew, as you're doing that, there's kind of I call it the bare minimum. There's the requirements, the things you have to do, according to FASB and the SEC. And then there's other industry groups that put together kind of best practices. To what extent do you leverage those, and how do you find them helpful?
We definitely are always looking for best practices, and I think it comes from a number of different groups, whether it's our relationship with Kroll. We have some close LP relationships that they are kind of sitting in John and Paul's seat and doing diligence for their manager. So we use those relationships a lot of like, what are you seeing across the board and other managers? How are they handling this? How do we stack up? So I think it's always just having your kind of ear to the ground of how the overall market's trending and what's best in class to ensure that you're kind of keeping up with that best in class. So I think it is kind of a range of different touch points that we kind of try to hit on to make sure, along with our auditors, that we are kind of always on top of any trends that are seen in the market of, oh, the SEC is going to be out here looking at this next year. You want to make sure that that's buttoned up and you really thoughtfully thought through it. So I think that's very important that you're kind of always consciously looking and understanding what's going on in the market and what is still considered to be the appropriate approach you should be taking.
Robert, one of the other things that we look at and the due diligence side, this may be going down in the weeds a little bit, but to the extent that an institution is looking to make a significant investment, I mean, these are the things that at least need to be considered. Is a manager changing their models and going back and forth between different models? That could be a red flag. Like, why did they use a discounted cash flow model one year and then choose some other approach? Like, I don't know, we're going to use market comps or pricing of similar securities that recently traded or something like that. So the change of models, why would that happen? That should be well documented. Like, why was the model that you used last year or last period no longer a good model to be used? Where are they sourcing the inputs to the model? In other words, if you're using a discounted cash flow model, there is the concept of a risk-free rate. Well, you could potentially change your risk-free rate from a 3-month T-bill to a 1-year T-bill or some other type of a security, and that may have an impact on the model. So who chooses the inputs to the model could also shade the valuations that are coming out to it. And then lastly, some of the things that Paul and I see is with certain managers, for instance, they may be trading in performing debt and all of their valuation processes are pointing towards performing debt, and therefore their process has a certain natural flow. And now when they start investing in something differently, like non-performing debt or European debt or sovereign debt, it is possible that the exact evaluation processes are no longer exactly the same. So to Andrew's point, that's why your valuation policy needs to be kept up to date and refreshed regularly, to the extent that your underlying portfolio investments change over time. All of a sudden you buy something that's denominated in other than US dollars, and now you're taking on the responsibility of hedging a currency. Well, does your valuation policy now reflect the obligation to value those other new securities which you previously never had in your portfolio? I don't know, Paul, do you want to talk about some of the other things that you've seen changes in evaluation process, like pushbacks or challenges, and some of the things that we've seen that evaluation policy was not necessarily kept up to date with what the manager was doing?
Sure, John. One of my personal pet peeves is evaluation policy that hasn't changed in years and hasn't been reviewed in years. It's okay if it is good and hasn't been changed, but it needs to be reviewed at least annually. Along the lines of what you were talking about with changes, we don't like to see shopping around or third-party valuation experts. It's okay to change once in a while, but we don't like to see different valuation firms come in every year. That could be an indication of potential problems. Some of the things we like to know on the ODD side is, will this the ultimate decider of price? Typically, the expert valuation firms will give you a range. It can be broad. It can be narrow. We like to see a more narrow range. As you noted, real valuations don't matter someone wants to sell, but we want to have an accurate track record evaluation of what we own across time until we do sell. And on the OD side, we'd like to see, as I noted, a robust and consistent process. If there are changes to it, we'd like to see those documented and explained, and we'd like to make sense.
And John and Paul, you touched on some great points surrounding policies and procedures and models changing. Just to touch real briefly, I think an important part of the guidance related to how to estimate fair value is following some basic procedures that often get lost, namely gathering all the market information that's available, evaluating the source of that, both from a quality and a quantity perspective, but also looking at the timing of that information. If you're looking at, say, a repo mark, what's the source of that repo mark? How did they estimate that? Is that reliable as some form of information? Are you evaluating its reliability relative to, say, a trade you may have, or a broker quote, or actual bid and offer information that's actionable? Are you looking at the source of that information and seeing how reliable it is and how informative it is as to where a transaction would actually occur? Oftentimes, from what I've seen, the process and the procedure don't take those things into account. They just take a bunch of information in. They may just take an average, something like that. And they don't really gather the information and evaluate it, and then use that to inform them as to what the most accurate or appropriate model would be to estimate fair value in light of the sources of those information. John, what do you see along those lines in terms of policies and procedures and how they can be improved?
I think we've seen bad people doing bad things for a long time. We've seen people, I think they use the term painting the tape, which is you're sitting on, a million or multiple millions of a particular instrument, and you trade a small amount, call it 10,000, at a price that's up a couple points. And you could potentially do it in the marketplace or just to lose a couple of dollars on 10,000 face. But you've now moved the price up. If it's trading and you think it's valued, I'll just use some broad numbers. You think it's valued at 65, and you're sitting on 10 million face of a particular security, and you can somehow trade 10,000 of it at 70 or 72, and now you're going to point to that number to value your whole portfolio, and move the price up from what was a reasonable value closer to 65 and call it 72. Guess what? And you're going to point to that small trade that happened near month end as an independent price, which you can point to value your underlying portfolio. So small trades away from the market are a problem. Trades in similar, or managers who point to quote unquote similar securities, but when you look at them, they're not really all that similar. They may have similar coupons or similar maturities, but the underlying instruments within the portfolio are materially different. Looking at the difference between a broker quote and a dealer quote. So obviously a dealer and a broker have different responsibilities. Dealers are paid to be making a market in a particular security, whereas a broker is independently shopping a trade, and may or may not be able to execute that trade at the market. They may trade it away for liquidity purposes. Then to point to that quote from a broker quote and compare it to a dealer quote are materially different inputs. The last thing I'll point out, there's a lot of managers that have robust processes, and I'm going to be pointing now to, let's say, the level 3 securities. Maybe not the same for private credit, but for quote unquote trading debt, which is really not trading very frequently. You go out to the market, you say, let me get broker quotes or dealer quotes, and you get 4. What happens when they're 82, 81, 82, and for some reason, some organization comes in at 65? What do you do with that really oddball quote? Do you ignore it? Does your portfolio valuation process allow you to ignore a quote that you see as materially wrong and materially away from the market? Or does your process say, we take our broker quotes and we average them? Well, you just averaged in what may be a bad price. Many good valuation policies will allow the concept of a challenge or a pushback to the price. So in my prior example, you could go back to the person who gave you the 65 quote and said, "Do you have the right CUSIP? Do you have the right security? Your price seems to be materially away from the market. It just recently traded at these set prices, 80, 81, 82 recently. How in the world did you come up with your price?" If your policy doesn't contemplate the idea of challenging, what is the process then for you to do it in a market where you, in the event that you get a really strange or unusual price that comes from somebody? And lastly, we see those types of things happen during the financial crisis, the great financial crisis, 2008 to 2010, where prices were all over the place. And you could end up doing an average price of prices that are really far apart. So exactly how you do it, what happens if you can't find it? Are you using a bid? Are you using an ask? Are you using a midpoint? Are you using a mean? All those things have different implications in there and what they may do to your portfolio. And if you haven't thought them through and the implications, you could end up materially mismarking your portfolio.
And John, you bring up a good point surrounding having policies and really procedures in place to recognize data and provide enough flexibility to properly take into account in a practicable manner the information as it becomes available. I mean, that's one of the things that from a valuation perspective at Kroll, we're constantly looking to gather as much information as possible. We actually have a large amount of data. You saw the charts that we put together earlier. I was talking to a colleague yesterday, and he was likening the private credit markets as being akin to where things were in the fixed income markets 30 years ago. And as more and more information has become available, many of these valuation challenges have become easier to deal with. Certainly, as you're going through these things and developing a policy and procedure, seeking out information, whether it's data to use as inputs, appropriate discount rates, credit spreads, whatever that data might be. Third-party valuations can be helpful, as well as having a robust valuation platform, which I think really speaks to the switching of models that you were referring to earlier, Paul. But just kind of running through here, we've talked a bit, and John, you mentioned kind of the value to investors of being able to see policies and procedures. What are you seeing in terms of transparency? Is that something? I mean, you're speaking to many different funds, John. Is this something that you see regularly? Do you get transparency to the policies and procedures, and how do investors interact with receiving that information or not receiving it?
We ask. We have a standard document request list, anything from cash movement policies to make sure we understand how the manager is moving cash and collateral and securities, all the way up to valuation policies, compliance policies, cybersecurity policies, and things like that. So it's broad scope of policies and procedures that we like to get copies of. Where we sometimes get frustrated is when we look at the policy, and they may have a beautiful valuation policy, well thought, well updated, but then you look at their marketing deck, you look at their DDQ. If it's a new fund coming out, a new vintage coming out, and you look to like the LPA or PPM or OM, whatever the document you're looking at, and you see inconsistency. So what they say in their valuation policy is not consistent with their answers provided to investors in a DDQ, or they're not consistent with how they describe the valuation process within the LPA or the offering documents. Obviously, that's why you have the meeting with the manager. But as an investor, what do you do when you think they have really well-crafted, well-followed policies and procedures, but what's in their marketing decks, their DDQs, their offering materials say something completely different than what they're doing? Is that fraud? Is it misstatements? Are you okay investing in a fund where what they are actually doing is materially different than what they tell you they're doing in their documentation? I mean, these are all things that we point out to investors to say, hey, they may be doing a good job, but all their documents sort of indicate that they're not doing a good job. And and we can't be sure that they're going to be following the good process because their documents give them a lot of leeway. So a lot of documents say we may choose to use a third-party valuation provider. And at the time we talk to them, they are using a third-party valuation consultant, a third-party valuation agent, or whatever you'd like to refer to them as. But because their documents give them the optionality, we can't be sure that 10 minutes after we walk out the door, they may never talk to any valuation consultant ever again because they've given themselves that optionality. So we would talk to a manager, an investor, and say, you may want to put that in some type of a side letter that says that even though their documents give the manager optionality, you want to see that they're always going to use them on an annual basis. So we look for inconsistency among documentation around valuation as a major, let's say, a yellow flag going towards a red flag because they're not doing exactly what they say they're doing. And that's usually a great way to invite regulatory investigation when what you're saying you're doing does not perfectly align with what you're actually doing. The regulators, the famous line is, say what you do, do what you say. And if you say one thing and do something different, even if what you're doing is good, the fact that it doesn't follow with what you say you're doing may be a regulatory flag, and it's going to invite regulatory investigation.
Can I just add something? We've come a long way from the days of give us your money and trust us. Yep, we're still seeing some issues along the way. One of the things we do get is better transparency. And frankly, an ODD person's nightmare is that everything goes great. They tell you everything you want to hear, and then you walk out the door and they turn around and completely change everything. Or they don't follow procedure, even though they've told you they are following their written policies and procedures. That is part of the reason we like to go on site. We like to ask to see valuations. We like to see historical records. We like to test to see what they're doing, much like an auditor would, to ensure that we are comfortable with their valuation policies and procedures, that they are in fact robust, and that they, most importantly, are in fact following them. That's one of the things we've seen. So overall transparency is getting better, and it's something we do follow up with typically.
And Paul has it straight right on. And I would say a lot of allocators do not take the time to look at the prior. There's some type of a transaction. They sold a portfolio company in a private fund, or they sold some of their credit positions. In December, they said it was worth 80, and now they just sold it in February, and they sold it at 60 or 90. That makes you wonder, how in the world did they get to a valuation of 80 at December year end when they issued the audited financials, but when they actually did the trade in the marketplace, or it matured, or whatever the case was, materially away from. So I think it's important for allocators and investors to consider doing spot checking and spot testing around what did the manager say it was worth, and then what did it actually trade at? Because if you find a big disparity that can't easily be explained between where they valued it and where it actually traded at, that may be another indicator that their valuation process is flawed.
And good managers will track their pricing versus where it ultimately ends up. They will know whether they are close or not.
I fully agree. Fully agree, Paul.
Excellent. So this is maybe a good time to move on to questions. We have about 10 minutes left, and I see a few questions in the queue. I guess the first one, with regards to independent valuation, the overall credit/debt market has embraced such valuation firms to provide the independent valuation analysis and frequency. What are you seeing from the private markets, such as private equity, venture capital, infrastructure, and real estate asset classes? Are they embracing obtaining independent valuations on the portfolio? And if so, what percentage of the market are you seeing embracing it by asset class?
ODD side, I think it's going to vary.
Yeah.
It's going to vary, obviously. Hedged assets, I think, illiquid positions within a hedge fund tend to use independent valuation if the investment is material. However, I see a lot of funds that is a 50 basis point or 100 basis point position within a portfolio, and they will often obviously side pocket or not actively value it. When it comes to the private marketplace, like the question says, private equity, venture capital, infrastructure, real estate, personal experiences, there's still a ton of reliance on manager marking. Any fund manager who happens to be on this call or who listens to this call later, I've always looked at the use of a third-party valuation organization, whomever it is, as an insurance policy. insurance against regulatory investigation, insurance against lawsuits around fraud or whatever it is. To me, it is just part of running a portfolio. And if you're looking to save a couple dollars around valuations, you're opening yourself up to potential litigation. So I don't quite understand organizations that are highly reluctant and aren't even considering using a third party to check their math. That's just my opinion.
Oh, sorry. Go ahead.
No, good. Please,
Paul, do you want to talk about frequency? What you're seeing as far as what are we typically seeing in frequency? Like how regularly are they using it?
I was going to comment that primarily the private markets are, in my opinion, 5 to 10 years behind public markets in terms of accepting best practices from what the SEC thinks they are. So we have seen an uptake in managers using third-party valuation firms overall. They're still behind the public markets, but there is more acceptance to that. Typically, it may be true that the manager is the one who knows the asset best and is best positioned to market. However, there is also this concept of sunlight and more eyes on an asset or valuation. We like to see that from the ODDC. It means there's not just one person dictating the price. There are numerous independent parties participating in a process to find and discover what actual price is.
And just to follow up, I think that private equity and venture capital, as Paul alluded, is a little bit behind liquid markets for valuation, and I think real estate's even further behind. It just has not had as much institutional sunlight, and we're seeing a lot more manager mark positions within the real estate infrastructure space, perhaps than private equity, venture capital, or liquid.
Yeah, it's funny you mentioned that, John, because if I were to look to areas where I've seen the most growth in demand for valuations, and this is just my personal experience, I would say that it's probably in real estate, infrastructure, private equity, and VC. And some of the drivers there is that I've seen kind of managers coming from, say, the hedge fund or kind of private credit side that have robust policies and procedures in place, entering into the private equity and the VC space and looking to employ their same practices on those asset classes. I think that's been an interesting change. We've seen a big increase in I think most people are probably familiar, but on the private equity VC side, there's the practical expedient that allows LPs to mark to a GP mark. And we've really seen a big increase in attempts to deal with the lack of timeliness of those marks. So often they're lagged 6 months, 3 months, something like that. But at the same time, you know that there's an exposure to the market. And as a result, you can attempt to make adjustments to account for how the value should have changed given what the market has done. But I think we're even seeing increases in demand for accurate real estate valuations. Appraisal work. It can be time consuming, but at the same time, it really lets you look into these buildings and see do you have a tenant? Are they actually showing up, or have they vacated the space and they're trying to sublease it and can't sublease it? In which case, they might still be showing up as occupying the space because they're still paying their rent. Being able to look in and test these things, and as Paul was saying earlier, site visits matter, and being able to look and hiring an independent valuation group to go in and review these things, or having your manager really document that they're looking at these items and that they've gone and checked these things out can be very important. John, I think you were about to say something.
Yeah, there's a famous hedge fund that blew up. The name escapes me. It was about a decade ago, I believe, and it was a liquid fund. So it was a hedge fund, and they had made some direct investments in oil wells, and a small percentage of side-pocketed investment. And we're putting out numbers and providing them to a third-party valuation agent that basically said this is the oil production coming off of those oil wells. And based on that data, the valuation consultant did their thorough job and did evaluation of that. They used the input from the manager of oil production. It turns out it was all fake. They were all non-performing. So again, it's not it. I'm just pointing out that garbage in, garbage out, whether it's a third-party valuation consultant or the manager, to the extent that they're relying on bad data, you're going to get bad valuations. In this case, I'm not sure that there's anything that the valuation consultant could have done, but you can see an unscrupulous manager who falsifies data. So, for instance, real estate says, "Oh yeah, here's fake leases for all the buildings that I have. They're fully rented and leased," and it turns out they're not. I mean, Kroll does not go out to every building and walk the floors. They don't go out to every portfolio company and check inventory sitting in warehouses. That's beyond the scope. So a bad manager doing bad things can get really sideways if they want to. If it's in their heart to do it, that they're going to do it.
But that's a great lead into the fact that doing this due diligence, whether it's going and checking or hiring someone to do some form of investigation to check on and ensure that these things are accurate, really it becomes quite important if you're looking at assets where these things could be questionable. Yep.
Rob, I think probably the second question in the chat's probably to you. Some large private managers don't want to utilize an independent valuation organization. They explained that they are the expert in that particular niche area or area of interest in investment. How do you, Kroll, deal with this, and how perhaps should investors get comfortable with a manager claims to have expert knowledge that surpasses the knowledge of anybody else?
That's an interesting question on a number of different levels. For one thing, when someone says that they have expertise, that should be something in a specific asset class. That should be something that they can document and explain. I think that there's a number of different approaches that Kroll uses here. To name a few, one is a valuation approach called assurance, and that's where an independent valuation person reviews what the manager has done to come up with their valuation and assesses the reasonableness of that in light of all the market information available. That's often I find that managers who state this really are either not following the processes required to estimate fair value, or they might be cuffing it, or they're having troubles translating in their mind what they think of into a valuation model that would kind of typically meet the requirements for ASC 820 or IFRS 13. And in those cases, having someone who's knowledgeable about valuation sit down with that manager and help translate to an appropriate model may be helpful. Lately, we've actually been doing that with a number of different managers, helping them sit down and translate. We've seen a bit of that in litigation finance really lately, but helping them translate that into models that meet the requirements for implementing fair value. And then finally, there are folks who are just recalcitrant, and it may be helpful to describe some of the items that we talked about earlier, John and Paul, about having robust policies and procedures, helping to keep investors investing, increasing that NAV. That can often help sell them on the idea of getting those folks involved. John, Paul, or Andrew, any thoughts along those lines?
I guess the last thing I'll just end with, it's all, at the end of the day, there has to be a process followed to get the valuation. And if the manager is saying there's something so absolutely idiosyncratic that it can't follow any model, they have to be able to explain that. If there has to be mathematics involved somewhere, there has to be inputs, there has to be a process. And if the process is just trust me, I don't think it's investable.
Yeah. And there's a few other questions. Unfortunately, we're running out of time here. And so we'll look to respond to those after the webinar. But we appreciate everyone joining. Andrew, Paul, John, thank you for joining me on this, and hopefully that was helpful to the folks watching this, and I hope everyone has a great day. Thank you.
Rob, thank you for the invite. Thank you.
Thank you.
Thank you.